This section of your course focuses on the application and underwriting. Insurance applicants are not guaranteed a policy. Instead, the applicant and the insured, if they're separate people, will go through the process to determine whether a policy should be issued. If the determination is made to issue a policy, it also must determine the premium and the coverage. There is no law that requires a carrier to issue a policy, and the underwriting procedures are also used to eliminate applicants who don't qualify for coverage. Insurable interest requirements must also be met for a policy to be issued. This is the primary reason that stranger-oriented life insurance is prohibited. These transactions ignore the basic idea for life insurance, to protect families or loved ones, as well as those with a financial interest in the insured, like creditors. Insurance contracts have terms, definitions, and concepts that are specific to the industry. Insurance policies are personal contracts. They insure people and not houses or cars or lives. These policies insure people who own cars, houses, and their lives. The life is the subject of insurance, owned by a person who desires life insurance coverage. Insurance companies run various reports on their applicants to make sure that coverage is both warranted and issuable. Just because a person wants a certain amount of life insurance doesn't necessarily mean that that's what will be issued. In addition to credit checks, medical histories, and other reports, insurers want to know about finances. A person applying for a $10 million life insurance policy that only earns $30,000 a year will likely signal a red flag in underwriting. Insurance is a contract between the applicant and the insurer. Once a policy is issued, the applicant becomes a policy owner and may or may not be the person insured. This is first and third party ownership of the policy, which is an important concept. Insurable interest issues could be present if the insured and applicant are different persons, whereas this is never an issue if there's first party ownership. Because insurance is a contract, we took a deep look at the elements required in order for a contract to be valid and legally enforceable. The acronym CLOC will help you remember the required elements: consideration, legal purpose, offer and acceptance, and competent parties. If a contract is missing any of these elements, it's considered void and cannot be legally enforced. Also remember, though, that even if a contract is legal, if one of the parties to the contract has been victimized by another, the victim can legally seek a rescission of the contract. The rule of strict construction mandates that contracts must be clear and concise, and if any part of a contract is unclear or ambiguous, a court can rule against the party that drew up the contract. Insurance policies are contracts of adhesion. When most people hear the word adhesion, they think of something that sticks together. This is the case with insurance. Insurance contracts are adhesive in nature, which means that insurance policies are not subject to bargaining or negotiation. Insurance policies are also aleatory in nature or subject to chance events. The insured only has to perform if a covered loss occurs, and the insurance company only has to perform if the loss is covered. The policy is in force and the premium has been paid.